Hello and welcome to Money Maximized. Today we are going to talk about monetary tools to tame inflation. Adjusting interest rates is a key tool used by central banks to manage inflation. The central bank typically increases interest rates to lower inflation. Here's how interest rate adjustments work to curb inflation. Increase in interest rates. When the central bank aims to lower inflation, it typically raises the benchmark interest rate, often referred to as the policy rate, federal funds rate in the United States. This rate influences the interest rates offered by banks to consumers and businesses. Higher borrowing costs? An increase in the benchmark interest rate raises the cost of borrowing for banks. Banks, in turn, pass on these higher costs to consumers and businesses through higher interest rates on loans and credit. Reduced consumer spending and business investment. Higher interest rates lead to increased borrowing costs for consumers, for mortgages, car loans, and businesses, for capital investments. As borrowing becomes more expensive, consumers and businesses tend to reduce spending and investment, respectively. Lower aggregate demand, reduced consumer spending, and business investment result in lower aggregate demand in the economy. When demand decreases, the pressure on prices subsides, and the inflation rate may decrease. Impact on prices and inflation. Lower aggregate demand can lead to a slowdown in price increases, contributing to a decline in the inflation rate over time. Expectations and forward guidance. Central banks often use forward guidance to influence expectations. Clear communication about the central bank's commitment to controlling inflation by using interest rate adjustments can influence market expectations, helping to curb inflationary pressures. It's important to note that the effectiveness of using interest rate adjustments to lower inflation may vary based on several factors, including the overall economic environment, the level of inflation, the response of consumers and businesses to interest rate changes, and global economic conditions. Central banks carefully monitor economic indicators such as inflation rates, employment levels, and GDP growth to make informed decisions about interest rate adjustments. The goal is to strike a balance between controlling inflation and fostering economic growth to maintain stability and prosperity in the economy. Thanks for watching, and don't forget to like, share, and subscribe.